The global markets in this year of 2025 are currently characterized by a notable degree of heightened volatility. This turbulence is not emanating from a single isolated source. Instead, it is the complex result of persistent geopolitical tensions across various regions, which continue to create an atmosphere of unpredictability. Furthermore, significant economic uncertainties cloud the horizon, making forecasting future trends a challenging endeavor for analysts and investors alike. These factors compel market participants to constantly reassess risks and opportunities. Investors are therefore closely monitoring policy decisions and economic indicators emanating from major economies, seeking clarity in an otherwise opaque environment. Strategic adjustments and a cautious approach are becoming increasingly common responses to these conditions. Adding to this complex economic picture, the United States has seen specific policy actions contribute directly to market fluctuations. For instance, President Trump's administration announced a new reciprocal tariff regime on April 2, 2025. These tariffs were, in many cases, higher than what market participants had initially anticipated, creating an immediate wave of concern. While some tariffs were postponed for a period of 90 days, and temporary exemptions were granted for certain consumer electronics, the overall announcement triggered extreme volatility within the U.S. stock market. The S&P 500 index, a key benchmark for U.S. equity performance, experienced a significant decline, falling over 20% before staging a partial, yet tentative recovery, as investors began to digest the longer-term implications of these trade policies. In this environment of uncertainty, market participants are keenly awaiting the release of key U.S. economic data for further guidance. The upcoming Q1 2025 Gross Domestic Product (GDP) figures are of particular importance. These figures will provide a comprehensive snapshot of the nation's economic output and growth trajectory during the first 3 months of the year. A strong GDP reading might suggest underlying resilience in the economy, potentially calming some market fears. Conversely, a weaker-than-expected figure could exacerbate concerns about a potential slowdown. These GDP numbers are therefore critical for shaping investor sentiment and influencing expectations about the overall health and direction of the U.S. economy in the months ahead. Beyond the GDP data, investors are also meticulously watching for the April 2025 Consumer Price Index (CPI) figures. The CPI is a vital measure of inflation, tracking the average change in prices paid by urban consumers for a basket of consumer goods and services. Persistently high inflation could compel the Federal Reserve to maintain or even intensify its tight monetary policy stance. Consequently, the minutes from recent Federal Reserve meetings are also under intense scrutiny. These minutes offer valuable insights into the central bank's deliberations and its collective thinking on future monetary policy. Together, the CPI data and Fed minutes are expected to significantly influence interest rate expectations, a crucial determinant of borrowing costs and investment decisions across the economy. Across the Pacific, significant developments in the digital asset space are reshaping the regulatory environment in Asia. On May 21, 2025, Hong Kong's legislature took a decisive step by passing a landmark stablecoin bill. This legislation establishes a comprehensive licensing framework specifically for issuers of fiat-referenced stablecoins. Under these new rules, any entity issuing stablecoins within Hong Kong or backing stablecoins with the Hong Kong dollar must secure a license from the Hong Kong Monetary Authority (HKMA). This move is seen as a proactive effort by Hong Kong to foster innovation while ensuring financial stability and consumer protection within the burgeoning digital currency sector, positioning the city as a key hub. The new Hong Kong framework imposes stringent requirements on licensed stablecoin issuers. These obligations include robust protocols for the management of reserve assets, ensuring that the stablecoins are adequately backed by highly liquid and secure assets. Furthermore, clear mechanisms for redemption must be in place, allowing holders to convert their stablecoins back into fiat currency reliably and efficiently. Comprehensive risk control measures are also mandated to mitigate potential operational, cybersecurity, and financial risks. This detailed regulatory approach aims to build trust and legitimacy for stablecoins operating under Hong Kong's jurisdiction, potentially setting a precedent for other regions carefully considering their own regulatory pathways for these digital assets. Meanwhile, India is also at a critical juncture concerning its stance on global crypto regulation. There are increasing calls from within the country, and from international observers for India, to adopt a more decisive leadership role in shaping these global norms. As other major jurisdictions, such as Hong Kong and potentially the United States, move forward with clearer digital asset frameworks, there is a growing recognition that India needs to articulate its position more definitively to remain competitive in this rapidly evolving technological and financial landscape. The choices India makes in the near future will significantly impact its ability to attract investment, foster innovation, and participate meaningfully in the global digital economy's development. In the United States, political actions are also significantly influencing the cryptocurrency market. The Guiding and Establishing National Innovation for U.S. Stablecoins Act, more commonly known as the GENIUS Act, has made notable progress. This piece of legislation has advanced through the U.S. Senate significantly with bipartisan support, indicating a growing consensus on the need for federal oversight in this area. The primary aim of the GENIUS Act is to establish a comprehensive and coherent regulatory framework for stablecoins at the national level. Such a framework is anticipated to provide much-needed clarity for issuers, investors, and consumers, potentially unlocking further growth and innovation within the U.S. digital asset ecosystem while addressing potential systemic risks. The cryptocurrency markets, particularly Bitcoin, have experienced a remarkable surge in early 2025. Bitcoin, the flagship digital currency, soared to a new record high, reaching an impressive $111,816. This significant market rally is largely attributed to a wave of investor optimism, fueled by expectations of imminent and potentially favorable U.S. digital asset regulations. The progress of the GENIUS Act, for example, has been a key factor in bolstering confidence. Further evidence of this heightened investor interest can be seen in the substantial inflows into U.S. Bitcoin exchange-traded funds, ETFs. These investment vehicles saw over $3.6 billion in net inflows during May 2025 alone, marking the highest monthly inflow since January 2025. Beyond price movements, significant institutional developments are also underscoring the maturation of the crypto industry. Coinbase, a leading US-based cryptocurrency exchange, recently announced a major strategic move, the acquisition of Deribit, a prominent crypto derivatives exchange. This acquisition, valued at approximately $2.9 billion, signals Coinbase's clear intention to significantly enhance its global presence and capabilities within the rapidly expanding crypto derivatives market. Such large-scale acquisitions are indicative of a broader trend towards consolidation and increased institutional participation, as established financial players seek to secure their positions and expand their offerings in the digital asset space, bringing more sophisticated financial products to the ecosystem. Another important indicator of stability within the sector comes from Binance, one of the world's largest cryptocurrency exchanges. On May 8, 2025, Binance released its 30th monthly Proof of Reserves (POR) report. These reports are designed to provide transparency regarding the exchange's holdings relative to customer assets. The latest report demonstrated robust reserve levels across various assets, notably including a substantial 206% surplus for Binance USD, BUSD, its branded stablecoin. The consistent publication of such POR reports is a crucial step in building and maintaining user trust, especially in an industry that has faced scrutiny over transparency and solvency in the past. This commitment to verifiable reserves helps to reassure customers and regulators about the platform's financial health. The broader financial markets are also reflecting shifts in investor strategy and capital flows that intersect with the digital asset world. For example, Japanese investors have shown a strong appetite for overseas equities. In April 2025, they purchased a net 3.27 trillion yen, approximately $22.37 billion, in foreign stocks, the highest monthly total recorded since at least 2005. A significant portion of this investment, 2.12 trillion yen in March 2025, was directed towards U.S. equities. This movement of capital highlights global investment trends. Simultaneously, given the prevailing market volatility and uncertainties surrounding tariff policies, many investors are actively seeking to hedge their equity exposure by diversifying into assets perceived as uncorrelated, such as Bitcoin and traditional safe haven gold. The commodities market, a critical component of the global economy, finds itself influenced by a complex interplay of diverse factors in 2025. Prices for essential raw materials, ranging from energy products like oil and natural gas, to precious metals such as gold and silver, and agricultural staples like wheat and corn, are all subject to these multifaceted pressures. Key global economic indicators, including GDP growth rates and inflation figures from major economies, play a significant role in shaping demand expectations for these commodities. Furthermore, ongoing geopolitical events such as regional conflicts or diplomatic tensions can swiftly impact supply chains and create price volatility, often with little advance warning for market participants. Delving deeper, the specific ways these global factors affect commodity prices are varied and interconnected. For instance, heightened geopolitical tensions in oil-producing regions can lead to concerns about supply disruptions, often causing a rapid increase in crude oil prices, which then has knock-on effects on transportation costs and inflation. Conversely, fears of a global economic slowdown might dampen industrial demand for base metals, while simultaneously boosting the appeal of gold as a traditional safe haven asset. Supply chain disruptions, whether caused by pandemics, natural disasters, or policy changes like tariffs, can also create significant bottlenecks, leading to price spikes for affected goods. Currency valuations also play a crucial part, as commodities are often priced in U.S. dollars. The policy priorities of major governments such as the current Trump administration in the United States also exert considerable influence on commodity markets. Stated goals like reducing government spending to support private sector investment, implementing further tax cuts for corporations and households, striving for fiscal sustainability, and pursuing deregulation across major U.S. industries can all have direct and indirect impacts. For example, deregulation in the energy sector might lead to increased domestic production, potentially affecting oil and gas prices. Similarly, fiscal policies that stimulate economic growth can boost demand for a wide range of industrial commodities, while trade policies directly impact the flow and cost of imported and exported raw materials. In conclusion, navigating the global markets in 2025 demands a keen understanding of the deep interconnectedness between economic indicators, evolving policy decisions, geopolitical shifts, and resultant market movements across all asset classes, including commodities and digital assets. The heightened volatility observed underscores the need for investors and policymakers alike to remain vigilant, adaptable, and highly informed. The path forward is unlikely to be smooth, characterized by ongoing uncertainties that necessitate careful risk management and strategic foresight. Success in this environment will depend on the ability to anticipate shifts and respond proactively to the dynamic interplay of these powerful global forces, recognizing that stability can be elusive,